All right, looks like we have a few more attendees joining. We'll just wait one more minute and then we'll start the call. All right, I think you can all see us. Perfect. Good afternoon. This is Colin Figueroa and John Lewandowski from the Alpine Financial Planning Group with Woodbury in Cresskill, New Jersey. In light of our current situation, we thought everyone can benefit from some human interaction, so we turned on the camera for the beginning of our call.
We'd like to thank Greater Alliance for giving us the opportunity to speak with you all today, as we think this will be time well spent given the current investment landscape. We have one of our partners, Michael Gregory from Goldman Sachs Asset Management, joining our call today. Michael will help demystify some of the volatility that we've recently seen and where we see opportunity in the years ahead.
It is our pleasure to introduce Michael Gregory of Goldman Sachs. If you have any questions, we should have enough time at the end of the call to do a Q&A session. If not, we're happy to share our contact information for you to contact us directly. Michael, you can take it away.
Perfect. Awesome, guys. Thanks for the introduction. Hopefully you can see my screen okay.
We can. It looks good.
Fantastic. All right. So the introduction from the gentleman, I greatly appreciate that. As they mentioned, my name is Michael Gregory. I'm with Goldman Sachs Asset Management. My role here is to really just educate people about what's going on about the markets. You know, it's been an interesting ride this year, and there's been a lot of questions. There's been a lot of information that's coming out very fast and furious. And the presentation that you have in front of you is called our Market and Economic Perspectives deck. And the title of this month's version is Riding the Storm Out, because we have been through quite a storm in the last 4 or 5 months when we're talking about the markets in general. Mainly because of what we're all experiencing right now, which is COVID-19 and the global pandemic that we find ourselves in. I am reporting live from my home office, which I've spent probably more time in the last 5 months than in my entire life. Calling in from Zoom is definitely the new normal for all of us, and hopefully there's no issues today. But without any further ado, let's just kind of jump into the presentation here. And this is very much a living, breathing document that's probably changed, I don't know, maybe 25, 30 times in the last few months alone, just given the amount of information that's come out around the virus and also how it's been affecting the global markets as a whole. So my goal and what what John and Colin have asked me to do is just talk a little bit about from a high level what's happened this year. Where do we find ourselves, and also, what's the approach from here on out? What are our expectations here at Goldman Sachs? And if you kind of take the executive summary page, I think it does a great job from a 30,000-foot view in educating you all about a little bit about the 3 U's that we kind of we talk about around where we find ourselves, and they would be unprecedented, uncertain, and unbelievable. So from an unprecedented risk standpoint, you had over 80% of COVID-19 cases are mild or asymptomatic, forcing the entire global economy into lockdown. So 95% of global economies essentially were in lockdown or self-quarantine of some form. So the ability to target the disease from a medical standpoint is virtually been very, very tough to do, because most people are asymptomatic or they don't really get any symptoms at all. Therefore, it's tough to figure out who has it. Therefore, test those people and eradicate the virus as a whole. From a record speed perspective, you had the S&P 500, which is essentially the largest 500 stocks in the United States in a one single index that's tracked on a minute-to-minute basis, plunge into bear market territory. And we've also had a swift recovery, almost nearly as fast as we saw it on the way down. We saw it come back nearly just as quick. So we saw record speed on the S&P 500 in both directions throughout this storm that we find ourselves. From a record uncertainty perspective, on March 16th, you had the VIX, the Volatility Index. So when I say the VIX, I'm talking about just an index that looks at the volatility on an average basis throughout the day of the stock market. And we saw that index actually hit an all-time high of 82.7, reflecting concerns around the coronavirus itself, its impact on the global economies. And we also had not a lot of liquidity, so not as many buyers as there are sellers within the market. So all of those factors really hit an all-time high on March 16th, ending in 82.7 on the VIX, which is the all-time high we've ever seen since the VIX was created. From a record low perspective, you had investors fleeing to bonds, specifically U.S. Treasuries. And U.S. Treasuries are issued in short-term and long-term denomination. And the entire yield curve, so 30 years down to 30 days worth of bonds, were yielding less than 1% for the first time in the U.S. history. So never have we seen that happen before. Additionally, you had the May crude oil contract, which was an options contract that was set to expire on April 20th, actually reflected negative $38 per barrel. So we've never seen oil contracts at a negative number. And the reason that was actually reflecting that within the markets is because we saw a lot of things happening at that point in time. We had an excess supply of oil, right? So they were still producing the same amount of oil around the world. So we also had a plummeting demand because people were not flying, they were not driving cars. And we had limited storage capacity just because we had so much on hand. So you actually had tankers floating off the coast of California and nowhere to put their oil. That's why you saw a negative $38 per barrel on the contract, not the actual oil itself, not the commodity itself, but the actual contract itself. And never have we seen that before. So that's what we're talking about from a record low perspective. On the flip side of that, you have record highs. When we're talking about record highs, we're referring to the U.S. initial jobless claims report, or the unemployment numbers. And we've seen 49 million people since mid-March actually file for unemployment, with that rate peaking in April at about 14.5. Let's call it 15% of the U.S. Workforce filing for unemployment in mid-April, which is an all-time high, which we've never seen, especially over the course of that time. It happened so dramatically as we were forced into self-quarantine measures. From a record policy standpoint, you had the U.S. CARES Act, initiated by the U.S. government, targeting about 13% of U.S. gross domestic product, aka GDP. It's been very, very sizable. It's also been very well targeted. So this actually impressed the market, which was nice, which has helped prop up the economy when we really needed it, as well as the Federal Reserve, which really controls interest rates. Did a lot of work as well in the attempt to help prop up the economy by adding about $5 trillion in support or liquidity to the overall markets, which these two things really helped us help the market prop itself up once we started to see this dramatic amount of volatility and illiquidity within the markets. From a bottom line perspective, you had physical separation policies, right? So what we're all doing for the most part and using masks and self-quarantining. At the same time, you saw economic deceleration. So a lot of these issues at the same time hitting the overall economy. But in our opinion, the recovery will be just as fast or just as swift as we saw the decline. So there is light at the end of the tunnel. We are not out of the woods just yet. We still have to see, how the economy will muddle through. We've seen some glimmer of hope within some of the recent numbers on the broader global economic scale, but there's still a lot of poor economic data that still needs to trickle into the overall economy as well. So the charts on the right-hand side are just reflecting, and I think the one on the top is a little bit more important if you had to ask me, but the top 10 largest single-day S&P 500 moves within the market going back to the creation of the S&P 500. And on the left-hand side, it shows you the single-day positive return days. On the right hand, you'll see the negative return days. And anything that's gray shaded represents what we saw in March and April. So 6 out of the top 20 single largest day moves within the S&P 500, whether they were positive or negative, happened in March and April of 2020 of this year. Just to give you an idea of how dramatic the market was moving in both directions throughout what we saw, given the fears and the concerns around the global pandemic. So some dramatic volatility and huge numbers in both directions on the upside as well as the down. All right. Now, if we move on to the next page, I am not Dr. Fauci. I do not pretend to play a doctor on TV either, so I will not spend too much time here. But the brief COVID-19 update is, and this is a little stale, so bear with me, right? So cases, this is showing you 12 million cases around the world. We're actually up to 13.6 million cases globally with 585,000 deaths reported. In the U.S. alone, we had 3.5 million cases with 138,000 deaths reported. So you definitely wanted to first just mention that my thoughts and condolences to anybody that's been affected directly by the virus itself. For the most part, we find ourselves in the Northeast, kind of the epicenter of this from a global standpoint. So definitely hit home for a lot of people, and our thoughts and prayers are with you all. The virus itself, the estimated coronavirus reproduction number per person, so per infected person, they infect about 2.3 more people. And I think that number is actually a little bit low, just given the fact that it is asymptomatic in nature, so it's tough to tell who's had it. And it's that number in our projections is probably pretty low, but based upon the numbers that we're seeing, it's 2.3 per infected person. So that also had placed 95% of global economies under lockdown measures. So essentially putting the entire globe in lockdown and really not being able to go about their normal business, therefore inability to stimulate the global economy. From a vaccine perspective, we're still about 12 to 18 months away in our projections from a timeline perspective and FDA approval and all that good stuff. However, there's definitely been a few companies that we work with, that we talk to on a regular basis, that have actually seen some good inclination that there could be something coming sooner. But there are about 250 potential treatments that are in screening phase as we speak. So some good news, some bad news, but altogether, hopefully we can get a treatment or a vaccine within the foreseeable future, and we do not get a huge second wave, as we're still dealing with the first wave in some parts of the country, hitting all-time highs and new highs as far as day-over-day case numbers. All right, so that is my Dr. Fauci impersonation. Not very good, I apologize, but let's talk about volatility. Let's talk about what keeps Goldman Sachs folks up at night. So there's a couple of reasons that allow us to believe that we are not out of the woods just yet from a movement within the market's perspective, right? So the first one is the labor force itself, which I mentioned. Right now, we find ourselves with about 11.1% unemployment through June, and that number has actually been going in the right direction as we start to see some states opening up to a more gradual phase as compared to some of the other states that are actually being imposing more lockdown measures that are actually having case outbreaks. But 1 out of 10 essentially Americans right now have filed for unemployment, which is not a great thing. From an election standpoint, you have election this year, and elections are not great for markets. The market likes to know what's going to happen, and if there's any surprises, you're going to start to see the market act erratically, and there's going to be added volatility as we approach the fall and the market tries to price in who's going to win, right? Because that's what the market tries to do. The market tries to price in what's going to happen in the future, and if it does not know what's going to happen, you're going to start to see volatility on the backside of that. From a regulatory standpoint, you had 20% of large tech companies on DC's radar. So if you take a look at equity market concentration, right now you have about 20% of the overall broader stock market being controlled by tech companies. And if you start to see legislation or regulation within that part of the world, the market's going to be affected because it makes up a huge broad swath of the representation within that stock market. So if you start to see areas being legislated as well as regulated by the government, then you're going to start to see the market act erratically as well. From a liquidity standpoint, I'm going to jump over credit a little bit, but liquidity, basically there hasn't been enough buyers as compared to sellers. And of the markets, of the trades that happen on any single day, 72% of U.S. equity trades or stocks happen by a machine or an algorithm. And if we see a glitch in the system, that's also going to add to volatility within the markets. And of the overall trades that happen on any given day, the last 30 minutes represent about 85% of stock market volume. So if we do start to see some of these algorithms act in haywire and their liquidity continues to be stretched, there could be potential, pitfalls, and volatility will also come back to the fray. So that's the stuff that keeps Goldman up at night. There are some good things that allow us to believe that the market is on stable footing, however. So this is the sources of stability that we see out there within the broader markets. So from a fiscal standpoint, you had U.S. GDP targeted, again, GDP is another way to think about growth, right? So when we think about what is GDP, it's just a way to measure growth on an economy or a country. So 13% of U.S. GDP has been targeted by the stimulus and loans package by the government. And if you take a look at the bar chart here, on the bottom left-hand side, you'll see that the stimulus and loans package was very targeted in its attempt to help alleviate some of the concerns that were brought on by the pandemic, right? So small businesses and loans to businesses, payments to individuals, right? Unemployment benefits as well. So it's been very targeted and very sizable, which has been very helpful in order to prop up the broader economy. From a central bank policy standpoint, you had 10 out of 10 major banks from around the world in easing territory. And easing monetary policy is good for the consumer. And the consumer is really, really important when we're talking about GDP as well as growth, because in this country alone, 70% of GDP or growth comes from the U.S. consumer. So I'll get into that in a little bit, why that's important and why we believe that the consumer is actually on stable footing. Inflation right now is almost at an all-time low at 1.1%. So the cost of goods is not going anywhere anytime soon, and you don't see the price of milk or oil trickling up in the near future, which is a good thing for us all. From a refinancing perspective, 13 million households could potentially benefit from refinancing their mortgages right now because the rates are at all-time lows. So maybe that is a conversation you want to have, with your local lender or, with Colin or John to see if that might be something advantageous for you to take advantage of as rates are at this level. From a household perspective, I mentioned this before, why households are important. So 23%, it represents the current savings rate per household. So essentially, folks are stocking away their paychecks and cash because they're fearful, which is not a great thing for the economy because we need people to stimulate the economy, therefore spend their money. But if households are well capitalized, that's a very, very valuable thing. So if you take a look on the bottom right-hand side, this mountain chart looking thing here, you'll see that household leverage is at a 34-year low. I just mentioned that inflation is low, rates are low, household savings rates are almost at an all-time high. So all of these things allow us to believe that the consumer is very well capitalized. And again, if consumers are well capitalized, we can get spending up and consumer confidence up. That will help stimulate the economy because 70% of, again, growth in this country comes from the consumer. So these are the sources of stability that we see there within the markets from a broad perspective that allow us to believe that we could get out of this sooner than expected, as well as that we are on stable footing from here on out. All right. So when we talk about growth, there's a lot of things that we know. There's a lot of things that we don't know as well. But our expectation is that going into this year, we were actually expecting about 2.2% growth for the U.S. We've revised that down to negative 4.6%, given the black swan event that we call, or the left field curveball event that we received given the pandemic. We revised that down to negative 4.6% for 2020, just given the impact of the global pandemic on the economy. We've also revised our global GDP expectations down to negative 3.4%. But here's the good news. Here's the silver lining. If you take a look in 2021, our expectations are actually pretty positive around the world. So whether it's developed markets, whether it's emerging markets, our world expectation is a positive 6.1%, and the U.S. at 5.8%. Just to give you an idea of how good that is, our target growth in this country is between 2 to 3%. So yes, this is a bad year for growth. There's going to be some hiccups associated with that. We're going to continue to see volatility through this, but our expectation is that next year, if we can get our hands around the virus, we can get people back to work, and we can stimulate the economy accordingly, then you will start to see a resurgence in 2021. All right, we talked about policy a little bit already. I'm not going to dwell upon this. What I will talk about is a little bit more on volatility, because that's what people are concerned about. So there's been a shift to higher volatility. It's been very quick, and it's been very large, right? So this just shows you the volatility index, aka the VIX, from 2007 to current date, the end of June of 2020, and you'll see major spikes within volatility. And this 2008-2009 global financial crisis, right? No surprise there. You'll also see the foreign debt crisis around 2011-2012, right? When you had all these countries trying to leave the Eurozone and going bankrupt, like Greece and Italy and Spain, et cetera. But the 82.7 number is the one we're most worried about, or the one that jumps off the page here, because that reflects the volatility around the coronavirus and how really fast it came and how unpredictable it was in nature. You saw volatility kind of get back to normal levels. We are not fully at this 20. This dotted line represents the average volatility on any given day. So we are not back to normal levels just yet, and we do think volatility does continue for all the reasons I mentioned previously. However, I just wanted to put into perspective how bad, and how dramatic things were back in March and April. Now, how do we compare it to previous bear markets? And we did find ourselves in a bear market in March, and the way that bear markets are characterized is a 20% pullback within the market. Right, so when you saw the market pull back to at least 20%, that's considered a bear market. And fun fact for you all on the call, if you have over dinner tonight, if you want to try to sound smart and impress somebody, or just a fun fact, the reason they call it a bear market is because bears, when they slash their hands, they slash down, and they call it a bull market on the upside because bulls thrash up, so their bull horns go up. So fun fact of the day. There's not many fun facts in finance, so might as well capitalize while I can. Bear markets, this is showing you the last 5 bear markets and the S&P 500 daily price changes that are associated with those bear markets. And from 1987 to 2020, again, we saw 5 bear markets. The plus or minus 1% through 5% just shows you what the market did on out of 252 trading days throughout that year, how many times we saw the market move plus or minus 1% through 5%. And in 2020 alone, we saw the market move plus or minus 1% 68 times. And then if you go all the way out to the right, we saw the market move plus or minus 5% 10 times. The bottom line, that average number, shows you the historical level of the S&P 500. And as you can see, just through June alone, we far extended the average amount of volatility just through the first half of the year. Does the second half of the year, is it going to be as volatile? Probably not, but it's not going to be a still quiet lake where we're not going to see volatility at all. There's definitely going to be some ripples within the water. There's going to be some huge moves around the election, our ability to contain the virus, and also there's still a lot of poor economic data that needs to trickle into the broader economy. So we're not out of the woods just yet. We are tracking for a volatile year compared to the previous years. However, if you look at the previous bear markets, we're probably at just about average before we get to the end of the year. All right, so when we're talking about bear markets in general, there's 3 different types of bear markets, right? And everybody's familiar with the story of Goldilocks and the 3 bears, I assume. Well, if Goldilocks had the ability to choose which bear market she could be a part of, she'd probably choose the event-driven bear market, right? And the reason being is the event-driven bear market, if you go down to the bottom here, it shows you 3 different bar graphs, right? 3 different bar graphs across the average decline, the average length in months, and the average time to recover in months. And there's the structural, there's the cyclicals, there's the event-driven bear market. And the structural by far is the worst type of bear market out there because it has the largest average decline, the longest length in nature, and the longest time to recover. Goldman Sachs is currently suggesting we are in an event-driven bear market, just given the fact that it's typically caused by a left field kind of curveball situation. However, we are suggesting this is an event-driven bear market, but it could become more structural in nature if we do see a huge second wave. We're not suggesting that's the case just yet, But again, if Goldilocks had the ability to choose which type of bear market she could be a part of, she would choose the event-driven. That's what we're suggesting that we're in. And we've actually already saw the market the last week alone finish up above where we were in March and February. So we've recovered almost across all the indices that we look at across throughout the bear market, that we've recovered since the all-time highs, and we're actually above those levels. So we are technically out of a bear market across some of the indices that we look at. Well, there is definitely going to be continued heightened volatility, and we could see the market pull back before the end of the year. All right, so I threw a lot at you. I'm not going to dwell upon politics, and I want to be cognizant of everybody's time. We're at about 1 o'clock here. As Colin and John mentioned, we kind of put this together just to give you a couple sound bites about what's going on throughout the world from an economic standpoint and what our expectations moving forward. So if I kind of had to summarize my comments and give you some key takeaways here, we found ourselves in a very uncertain time with a global recession on the heels of the global pandemic, right? And a recession is 2 negative quarters of GDP, right? So that's the definition of a recession. So we technically still are in a recession as far as that definition is concerned. Our expectation is before the end of the year, we move out of a recession as we start to see, businesses and some industries come back online and positive GDP growth. Through Q3 and Q4, our expectation is we move out of a recession before we hit 2021. But given the unprecedented nature of the virus and our inability to target medically, you saw a lot of growth being squashed, right? I showed you what our expectations are for GDP for this year, but the sequential acceleration, not only from a markets perspective, but from an economic perspective, are actually really good. The markets have recovered dramatically due to the fact that we had a tremendous amount of fiscal and monetary policy support by the government and the Fed. Volatility, we are not out of the woods just yet, so there's going to be some movement within the markets for sure. But there's tail risk from the virus as well as illiquidity, and this is an election year, so we're not done with volatility whatsoever. So it really makes sense to have conversations with folks like with John and Colin, just to make sure your portfolios have the ability to withstand volatility if we do see bouts of it, which I can pretty much tell you we will. Also, everybody's situation is different, right? Everybody's risk tolerance is different. Everybody's money is earmarked for something different. So make sure you're having conversations with these folks. They put this call together as a value-added service just to tell you a little bit about what's going on within the markets, because this has been a pretty wild year. So my recommendation is to have conversations with them. Make sure you're setting up time to speak with them. Now is a great time to do so, considering we're all pretty much locked in our houses for the most part. But diversification is definitely key. Try not to be overly tactical. Try not to chase returns or figure out who's going to be the leader in the run for a vaccine, because it's going to be a pretty wild ride if you try to do so. Okay. So with that said, I'm happy to answer any questions, but before we do so, I'm going to turn it back over to our hosts here of Colin and John, and I appreciate everybody's time.
Michael, thank you so much for that market update. Very helpful. A lot of value add content there. One question for you. Does Goldman have a price target for the S&P, whether it be 6 months out, a year out? Have they come out and put a number on the board?
Yeah, we have. We definitely have. And I am happy to show you. Just give me a second here. Let's see, slide 7. Next slide. Next slide. All right, so these are a little dated, and we've revised these since. But this came out in early July. The market itself has benefited recently from some good performance and some good news from ISM and production numbers, so help buoying things. But right now the S&P is at 3207 currently as we speak. Our expectation on the S&P 500, as you can see right here, was 3100 by the end of the year. So 3,100 by the end of this year was our expectation. Now we've revised that a little bit up to about 3,300 on the S&P before the end of the year. The reason being it's not that dramatic, 3,100 to 3,300, but in our expectation, things are going to continue to get better. But we're going to start to see growth tick up in 2021. But our expectation is from next year to 2030, you can expect about 6% return across broader equity markets for the next 10 years. But our expectation is that the S&P 500 before the end of this year hits around 3,300.
Beautiful, beautiful. Thank you for that. I'll open it up for any questions right now in case anyone has any questions for either myself, John, or Michael. I don't see anything in the question queue or any hands raised as of yet. So I think we'll wrap up the call. And we'd certainly like to thank you all for joining the call. We'd certainly like to thank the Greater Alliance for giving us the opportunity to speak with you. And we'd certainly hope to have additional webinars on the board in the next coming weeks. So keep an eye out for those on the Greater Alliance website. If you have any questions or would like to reach out to us directly, please feel free to give us a call. Our direct phone number is 201-663-0882. We will also send a follow-up email to everyone with our contact information if that makes it easier. Thank you, Michael, again for joining us and giving us that very value-add presentation. And we hope everyone has a great day.
Thanks, guys.
Happy to help, guys. Have a great day.
Thanks, Mike. Take care.